A new report just came out which said that our GDP, our economy here in the United States, actually grew by 2% instead of the 1.3% that was originally reported, which means that our economy wasn't slowing down as fast as a lot of people thought, which has a lot of people wondering, is the recession canceled? Are we still going to see a recession? Are we still on pace to see an economic slowdown ahead? Is inflation really affecting us? Are the higher interest rates really affecting us? And this is where I want you to pay attention to a couple different things. Number one is what's happening in the economy and what is the delayed effect of the higher interest rates? Because if you look at the economy right now, how did we get into the situation that we're in right now where we still have high inflation, where people are still struggling to pay for a lot of different things, yet the prices of things are still rising? Well, in 2020 and 2021, we saw the most amount of money printing ever. According to the NASDAQ, it was close to $13 trillion of new money that was created, that was injected into our economy, which is a lot of money. So you had all this money created and injected into our economy, which means now all of a sudden, people have the ability to spend. Businesses have the ability to spend. Businesses have the ability to hire more people. Businesses have the ability to expand operations. Businesses have the ability to open new offices. People have the ability to buy more stuff. People have the ability to finance more things. People have the ability to apply for more loans, which created a whole flood of new money entering our economy. Today, the Federal Reserve Bank is trying to cool down the inflation. Inflation is when you decrease the value of the dollar by printing more money. We had so much more money created that the value of our dollar dropped, which is why the prices of things have risen so quickly. Now the prices of things have risen so fast that the Federal Reserve Bank is trying to cool down this high inflation. They're trying to cool down the speed at which prices of things are rising. How are they doing that? By raising interest rates. But you have to remember, they're raising interest rates to combat all the money creation that happened in 2020 and 2021. And I don't think anybody really realizes the full impact of all that money printing, which means it's going to take time and effort and even economic pain to get this excess money out of our economic system. Because people today still have the ability to spend. Is it easy? No, we are seeing credit card debt levels break new record highs. We're seeing people dig into their savings, but people still have the ability to spend. Why? Because we saw incomes grow, we saw new jobs be created, which also means that people have more credit worthiness. In our economic system, there's two kinds of money. You have the money that you work to earn, and then you have your credit that you qualify for. Because in this economic system, we live in a credit-based economy, which means people spend not based off of how much cash they have in their bank account, but based off of how much credit they can qualify for. So now if you have $100 in your bank account and your bank is willing to extend you $100 worth of loans, credit cards, or debt, you can have $200 worth of spending power. So over the last couple of years, not only did spending power increase because of more money, but then also credit worthiness skyrocketed because we had low interest rates and higher incomes and more incomes because more people had jobs, which means credit worthiness also boomed, which created more ability for businesses and people to spend. Now, what we're seeing happen today is more and more people are going into debt to continue funding their lifestyles. There's going to be a limit to how much debt people can ultimately rack up, especially considering now that interest rates are significantly higher than before, and the Federal Reserve Bank keeps signaling that they're going to keep working to raise interest rates. So if interest rates keep rising, while debt levels keep rising, you're eventually going to hit a point where people will not be able to continue spending. Now, when will that be? You have a lot of different projections and opinions. Deutsche Bank says that it's going to be towards the end of 2023, around October 2023, when this excess money is going to start dwindling away. And when you start to see that excess money start dwindling away, it's going to be harder for people and businesses to continue spending the way that they were before. When that happens, you would expect spending to start slowing down. If spending starts to slow down, that could cause more economic pain and a cool down in the economy because businesses don't have the same revenues to support the higher expenses. Why are businesses seeing higher expenses? Well, for number one, you have all the inflation that we've seen happen. So now businesses have to pay more money in salaries, they have to pay more money in their rents, they have to pay more money for all their costs. And then you also have the rising debt servicing costs because in 2020 and 2021, businesses loaded up on debt because it was so cheap. But business debt is not a 30-year fixed rate mortgage. Many times it is an adjustable rate mortgage that readjusts every 3, 4, 5, 6, or 7 years. And so now what we're seeing happen is that in the next coming 18 to 24 months, we're going to see a lot of this business debt readjust at the higher interest rates. And interest rates today are significantly higher than where they were back in 2020 and 2021, which means we could see the costs of servicing these debts skyrocket for businesses at a time where spending is also declining. So when people talk about, oh, are we going to see a recession or not? Recessions happen. It's a part of our economic system. It's not a matter of, are we going to see a recession or not? The question is really, how bad is it going to be? Because if we're still seeing high inflation when we go into this recession, the Federal Reserve Bank is going to have a more difficult time stimulating our way out of this recession. Because if you look back to 2020, 2008, 2001, every time we had these recessions in the past, the Federal Reserve Bank could inflate and stimulate our way out of the recession. They could print money, do quantitative easing, we could send out stimulus checks, we could do a lot of things to stimulate and boost the economy. But if you're facing high inflation, that then poses a lot more issues, because before 2020, before 2008, before 2001, high inflation wasn't a concern going into the recession. Now we still have the high inflationary issues. Inflation has fallen, but is still very high, which means if the Fed started cutting interest rates, you're going to see more spending. You're going to see a boom in the economy, but that's also going to cause prices to rise quickly again, which would push inflation higher. I mean, just think about it. If mortgage rates went down to 3% tomorrow, what's going to happen? People are going to want to buy homes. You're going to see bidding wars for homes. If you start to see more bidding wars again, home prices are going to skyrocket. If home prices go up again, your inflation numbers are going to go up again, which then means the Federal Reserve Bank would have to start raising interest rates again to then cool down this inflated housing market. That's the tough situation that we're in. Now, we've been covering all of this in Market Briefs. Market Briefs is my free financial newsletter, which is why if you have not joined Market Briefs yet, I highly recommend you do so, because it's an easy and free way for you to stay up to date on what's happening in the economy, in the housing market, in the stock market, in the crypto market, and the global economy into a fun, witty, and easy to read email. If you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. But let's take a look at this article. It says the gross domestic product, GDP, our economy, increased at a 2% annualized pace for the January through March period, the first quarter, up from the previous estimate of 1.3%. And then we go down to see that the upward revision helps undercut the widespread expectations that the United States is heading towards a recession. What does this mean? The economy didn't slow down as fast as people would have liked, meaning people spent more than what was originally reported. How are people spending? Well, they're spending from their incomes. They're also spending from credit card debt, and they're also spending by going into their savings. Consumer spending rose at 4.2%. That's the highest quarterly pace since the second quarter of 2021. Why are consumers spending so much more money? Well, either people are becoming so much more richer that they have the ability to spend, or the higher inflation is forcing people to spend more money. And this is what we're seeing happen in a lot of different instances, where the high inflation is forcing people to make a decision. Do you either cut back on your lifestyle, or do you go into debt to fund your lifestyle? And what we're seeing happen statistically is more and more Americans are saying, you know what, I don't want to give up the nice restaurants and the nice vacations and the nice home that I have right now. So let me just put a little bit of it on my credit card, or just dig a little bit into my savings to continue funding this lifestyle that I have. But this next part is really interesting, so pay attention to this. An 8.7% boost in the Social Security cost of living adjustment likely boosted the consumer spending numbers, according to the senior director at Moody's Analytics. The boost in Social Security is what was a big factor in the boost in spending in America. Now, this is interesting because if you have been following what's going on with Social Security, the Social Security fund is running out of money, which means they have less money coming in than money going out. Why is that happening? Well, people are living longer, poor management of the money. Social Security is essentially the costs are higher than the revenue. So now, in order to fund this Social Security and the Social Security bonuses, because in the last couple of years, the Social Security payouts have increased pretty significantly in order to fund the higher lifestyle adjustments for inflation, how is the government going to continue funding Social Security? Because it's not like the government wants Social Security to go down to zero. How do they continue funding it? Well, if the government has to keep funding Social Security, they can either raise their Social Security taxes, which they haven't really done, or they can print the money. So now if we start thinking about this, the higher Social Security checks, the higher Social Security payments are contributing. I mean, according to this article, that was one of the biggest contributors to the higher consumer spending, bigger Social Security checks. Okay, the Social Security fund doesn't have the money to continue funding these bigger Social Security checks. So how do we fund that? The government has to print the money to fund bigger Social Security checks. If the government is printing more money to fund bigger Social Security checks, is there a cost to printing money? Well, the cost to printing money is, well, inflation. Because when you print more money, you are devaluing the currency. So the government printed or is printing more money to fund bigger Social Security checks, which increases spending, which increases demand. But the money printing is what's causing, or is a cause of the prices going up. So it's kind of an interesting conundrum where in order to fund the higher prices, the government has to pay out bigger Social Security checks, but the bigger Social Security checks are what's causing the higher prices. So this is where you can start to see the issues where money print, you cannot inflate your way out of an inflation problem. And the issues that we have in the economy with inflation, the higher interest rates, and the slowing economy are nowhere near from over. And that's why I keep saying 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart, because when times are okay, you want to be preparing for when times are not okay. Now, when is that going to happen? Who knows? We don't know if we're going to start to see more pain in 2024 or 2025, but the reality is we have seen interest rates skyrocket. There's going to be a consequence to that. We are still seeing high inflation. There's going to be cost to that. We are seeing the economy slow down. And eventually, if people keep going deeper and deeper into debt to fund their lifestyles, eventually that's going to break. Eventually, people are going to have to stop. There's going to be a cost to that. And so your job now as a financially educated person isn't to be panicked and to be worried and to freak out about what's happening, but rather understand what's happening, be prepared, and be financially educated. That way you can capitalize on the opportunities. And that means right now, working to spend less money, working to earn more money so you have more money to invest, and learning about investing. Maybe start investing. That way you can start putting your money to work. That way you can capitalize on the system, because like we've been saying, when you see market crashes, when you see recessions, everybody gets angry. You can see it every time something bad happens in the markets. People get angry in the comments because they're upset at the system. They're upset at something. But these things should not be shocks. These are parts of the economic system. And the slowdowns, the recessions tend to happen when most people don't expect it to happen, which is why your job is to be financially prepared. That way you can be ready for whatever might be coming in the future, and just understand where the red flags are. And if you believe nothing bad's going to happen, that's fine, but it doesn't cost you anything to be prepared. It can cost you everything if you're not prepared, but it doesn't cost you anything to be prepared. So whether you think something bad's going to happen or not, it's better for you to be prepared. That way, number one, you can protect yourself. And then number two, you can capitalize on opportunities that might come your way. The Federal Reserve Bank is officially starting to pivot. Jerome Powell has just taken his foot off of the interest rate accelerator with the first interest rate pause in 15 months. And this comes at a time where inflation is still running hot. Now, the interesting thing about the Federal Reserve Bank's latest move was that Jerome Powell still said that you need to be prepared for more